buying in the right market. I've been in good markets, but my markets have improved substantially since I started. I mean, if you you're in the Toronto area, and if you like Toronto, that may be a great market. I don't know the Toronto market. There are a lot of great markets in both the U.S. and Canada, and I've chosen some of them. And somebody else says, "Well, what about this market? What about that market?" And my only answer is, I know those are good markets as well. It's just I've got to zero in on a few of them and become really knowledgeable and informed about these markets. And I've chosen these for now. Not that I wouldn't add another one in the future, but you really need to know your market and choose ones that have the right attributes to them. They need to be population growth, jobs growth. Look at the household incomes and housing prices, and are companies moving into them, and what's the population, and a few of these metrics, crime rates and things like that. And it's not just the big city, it's the submarket around that city that is most important to you, that will determine your success or failure in that property, really, because whether you can get tenants or not, tenants not going to come into a property that's in a war zone area, where there's graffiti around, where there's a lot of other shady businesses, where that
crime rates up.
Yeah, high crime. That's a deterrent for sure.
Yeah, no, for sure. And then how do you set up, John? I'm sure there's a management fee, a management cost through the process, right? Your time is valuable and you can't do it for free. What do you normally charge for managing these projects for the investment group?
There are some fees involved. Ideally, if you're a passive investor and you want to invest with a syndicator, like myself or like a lot of other ones, you want to know that the syndicator's interests are aligned with yours, and so the syndicator should get paid after the passive investors, the limited partners, are paid. And so the structures of these deals are typically that the first X amount of cash flow that it produces in that quarter goes to the limited partners, the passive investors. Then, if there's more, then maybe it all goes to the general partners, or maybe a portion goes to the general partners and a portion goes to the limited partners. There are different ways of cutting all that up. That's one way that the general partners can earn fees from doing this business, is by operating well, by doing a good job at the operations of the apartment. A lot of properties, and I've done this also, will also charge an asset management fee. And so asset management is different from property management. Property management are the people that are on site, that are day to day. They're taking the phone calls to fix issues, they are collecting rents, they are finding new tenants, and all that day-to-day operations. If you're a tenant and you got a problem, it's the property manager who you need to call. The asset manager is the ownership team, the managers, the general partners on the ownership team, who are deciding things like, how many units should we be renovating? How much should we spend on a renovation? What kind of finishes should we do on these renovations? Do we want high-end granite countertops, or is that too much for this particular market? Making decisions if you have capital improvement or capital expense funds, and there's a problem like with the roof or the gutters or with overhanging trees or with various things like that. Where do we spend the money? Your asset management team should be determining that, and they're going to be on the phone with your property manager on a regular basis. It might be weekly or even more frequent than that, or maybe bi-weekly, depending on the condition of the property. And they're getting paid a fee, and it might be 1 to 2% of the rents that you're getting, in order to keep performing that. If you, as a passive investor, you want to know that your general partners are focused and are doing well by owning this, that they're not just losing interest because it's experiencing some problems, and so we're not as interested in it anymore. And they're gonna, I mean, they're not that they're gonna walk away, but they might be less motivated than otherwise. You need to know that there is some compensation there for them. They're not going to get rich off of asset management fees, and it's not ripping off limited partners at all. Their big payday is when they sell the property. They've got to get the value of that property up, and it's got to be over and above the passive investor. First, the passive investors have to do well, then the general partners can do well. And
Yeah,
so
and I think that's the big key, right? Is making the money over time through inflation, where when you sell that
yes.
property, there's a good spread out for the investors and for the for the passive investors for it. What are some of the returns that somebody through your company, John, will make? What are some of the what do the returns look like for someone?
We are typically projecting returns of about average annual return of about 20%. And so for a 5-year period, you should double your money between cash flow and the appreciation of the property. You should double your money. We've done better than that on average. And we try, I mean, everybody says this and everybody tries to be, we try to be as conservative as we can. And in terms of what our projections are, but these aren't guarantees. The cash distribution amounts might be 6, 7, 8% or so, and depends on deal by deal. Which means if you invest $100,000 in a deal, and the preferred cash flow distribution return is 7%, then assuming that the property is producing this much cash, you would get $7,000 through the course of that year. That's just your cash return. That's not appreciation, and that does not reduce your total capital investment. You still have the same amount of equity that you started with. It's just cash return, and then you'll get a share of the equity, the appreciation, when you sell the deal as well.
In these situations, John, are you give or provide any guarantees on a return?
I don't. No, and I don't know how anybody can. I've heard about a guarantee.
Because markets go down, right? We're in a market where interest rates went up. Values have come down.
Yeah.
As long as it's producing cash flow, I think you can determine based on an approximate return on the investment for that monthly income that property will generate. But you can't predict markets, right? Whether the market goes up by 10% per year, or 5% per year, or 20% per year.
Yeah.
So
a legitimate operator is not going to offer a guarantee. If you hear that, you should be super skeptical about what's going on behind that. How can they do that? What's backing up their guarantee? The credible operators just have a track record that you should look at. Like they've not done capital calls. They've not lost investors' money, returned properties to the bank. Maybe they had a property that they projected 20% and it only returned 12%. That's not a deal killer. 12% is a good return, not what you were expecting in one case, but it's still a good return. And hopefully their average is over 20%, looking at a deal. But you look at all those things, you assess the operators and what their team looks like, their experience, and have they gone full cycle in deals? Meaning that have they sold some of the deals that they bought, or are they brand new and still buying deals? And they still might be good, but
this may be a dumb question for you, John, but how do you guys determine when you're going to sell a property?
It is several things. We start off ownership of every property. Well, actually, even before that, looking at a property, in order for us to decide that it's something we want to buy and put a team together and look for investor capital on it, we need to know what we're going to do to that property to improve value. So it becomes a business plan, a business execution plan, and that execution plan is communicated to the investors. This is what we're going to do. How we're going to do it. We're going to invest whatever $6,000 in renovating a unit, and we'll be able to add $150 a month to the rent after we put it back on the market, whatever those numbers happen to be, and therefore they produce this return, and that all of that information is in your business plan. A lot of times you're out there renovating units, and you have reached the goals of your business plan before 5 years. You're maybe 3 years into it, and let's go back to say 2020, 2021. There was an excited excess demand from buyers for multifamily properties. If you're in the middle of that kind of a market, you might decide, wow, now's the time I should really be selling, because this is I'm going to get top dollar and return investors money to our investors, and they can go put it in something else, or they can sit on it for a little while. But we're gonna sell it now, as opposed to wait for 5 years. Other times, like if you've got a property now and it's cash flowing and doing well, you might have been thinking of selling it because you executed your plan, but it's a difficult market today. As you know, the interest rates are up, and investors are skittish, and it's difficult to find a buyer for a property today, and so you might choose to hold on to it for a while, whatever that number is, 6 months or a year or 2 years or something like that.